Well, we know the economy is on absolute fire, and now we're hearing President Trump leaving these tariffs in place. In fact, going to go to $200 billion, 10%. But, you know, it hasn't impacted us so far, none of this, right? We learned on Friday consumer sentiment at its second highest level since 2004. We have a wind in our sails heading into the fourth quarter. We have store after store, business after business hiring thousands, hundreds of thousands of holiday workers. And President Trump touting all of this on Twitter. But he did issue a strong warning, right? Best economic numbers in decades. If the Democrats take control, kiss your newfound wealth goodbye. Joining me now to discuss it all, Monica Mehta, Seventh Capital Managing Principal, and Lindsey Bell, CFRA Research Investment Strategist. Lindsey, let me start with you. First is breaking news. So it was what we thought in the morning. It'd be 10% tariffs on $200 billion in imported goods, essentially a $20 billion tax. Last quarter, U.S. corporations made $2 trillion in profits. Should $20 trillion, will that be enough to derail this locomotive we've got going right now?
Well, I'm not entirely sure, but we will start to feel the impact because the first $50 billion in tariffs that went on, they went on to steel and aluminum and lumber and things like that. And those are things that you see are going into making products. So it takes a while for that to actually hit the consumer. These are directly on consumer products. So we're going to start to feel that. And the consumer is making more money. They're feeling extremely confident, like you already said. So they might be willing to deal with higher prices to an extent. Let's see where we get though next year in 2019 when those 10% tariffs turn into 25%.
Right. Of course, that's one of the reasons they're coming after the holiday season. You know, what's interesting to me, because when you bring up the idea of can consumers deal with it, I look at, for instance, the automobile sector. And last month in August, the first time in history that cars were less than 30% of the total. People are paying up for SUVs, for trucks, for crossovers. So people certainly are more flush and more confident to spend that money. So how much of an impact do you think this will have, Monica?
Well, again, I think Lindsey's point is excellent. We haven't exactly felt it in the market yet. There is a lag. But the consumer is in good shape. Consumer has taken the last 10 years to really get their house in order, and debt levels are at the lowest they've been in the last 10 years. Or actually, I think there's a much bigger risk factor is with corporates. If you look at corporate debt, now that's a completely different story. And so, you know, with steel, like, you're going to feel it next year, just as Lindsey said.
Sure. So then what are you concerned about with this market, if anything? As we head into the fourth quarter, where do you see us going?
Again, I don't think that earnings are going to derail things. I think it's going to be something that comes out of the blue. I mean, this is a mature market, and you're seeing all the signs of a mature market. Hiring is good. People are spending. But then, you know, that catalyst comes into play. And it could be trade. It could be something that happens with an emerging market, because we're seeing a lot more disruption in across the world. Right. And how that trickles here is something to be seen.
Who could forget the Thai baht, right? I mean,
yes.
Sort of like the pea in the mattress thing or whatever that was. But Lindsey, what are you concerned about, and how do you see the rest of the year playing out?
Well, I think there's definitely a couple things that you have to keep your eye on, because growth is going to slow next year, because simply part of it's because you're comparing yourself to 20% plus earnings growth for 2018. 2019, we're going to get about half of that. GDP growth is going to come in just a tad bit because the tax effect is going to have worn out, and you're also going to see the fiscal spending be reduced. For the stock market, I think it's going to be, you know, lower growth. Right now, we have 3,100 on our S&P 500 price target. Mm-hmm. That's below 10% growth year over year, which is, you know, about average. Okay. So not bad,
all right,
but expect a little bit of a slowdown.
We have to leave it there. We had a lot of breaking news, but thank you both.
Yeah.
Great seeing you.
Thank you.